This is Justin Pulitzer. This is my weekend review video for Sunday, December 6th, 2015. Getting a little bit low in terms of days until the end of the year, but that doesn't mean that there's not a lot of market excitement that's going on. Anyhow, let's dive right in. I like to begin each video with my 6 market keys, and these are 6 factors I see as being very directional for the overall S&P 500 index. At any given time, one of them can take over and kind of dominate the discussion, so to speak, but let's go right through them. The first being the VIX. As you can see, we had a little bit of a spike in terms of volatility, I guess, midweek, and then by the end of the week, it dissipated quite a bit and came back down to the range lows. It's almost as if it never had happened. I will caution in the fact that the VIX does have a sort of floor. It's significantly lower than we are now. It's been, in the 11s for the most part. This low even touched down into the 10s, and we've kind of leveled out in the 12s or so. So we are getting a little bit lower. So if there is a bit of a, I guess, depression in terms of volatility here, it might be an opportunity to, I've been saying to play directionally, either long or short via options. We do tend to, when we get down here, wind up getting corrections in the broad market. You can see this has been met violently with spikes up, and this being the most extreme example. But we are holding below the 50, below the 100, even the 200, even the 20. We are below the averages. This is all very good for the bulls, but I will say that we are getting a little bit late in the low IV game. My biggest concern for the market, and I've said for a while, is the strong dollar. So the big concern has been obviously the Fed raising interest rates. There has been a lot of discussion, and based on the probabilities of the Fed raising interest rates, it went from like 0 to up to like 80%. I do believe as we get a little bit closer to the Fed that number is going to get closer to the 50-50 mark. I don't know if we're going to get to exactly 50-50, but I don't think it's going to be 80-20. So the dollar did break out here. I've been using the UUP. That's just the ETF. And we sustained above the breakout. And my fear has been that we retest the high and go still higher. However, we had something that kind of didn't go along according to plan happen the other day, and that was the ECB. So Draghi, who is their version of Yellen, came out and said that they are going to continue doing QE, but they were going to keep the pace the same, meaning they weren't going to increase, and this was a very big disappointment to the market. This rallied the euro and tanked the dollar, and it took out into the breakout level. It came back into that range. You can see that there is a range high and then a breakout level here. We came into the range. On Friday, Draghi, being who he is, he's very, very dovish, decided to use the opportunity to clarify, and basically in a press conference he was asked, and this is basically the exact words, was he using this to clarify the stance of the ECB, and he first was playing a little coy. He goes, no, and then he goes, of course. These were his exact words. And that, of course, took back a lot of, it didn't take back all of the decline, but it took back a lot of the decline. I believe that they are committed to trying to get the dollar and the euro as close to parity as possible, possibly even through there. I think that he's walking a fine line. A lot of people don't remember, but when the euro first came into play, the talk was to stabilize the euro because the euro was basically in free fall. They were able to do this, and we all know that the euro got quite strong once it was fully adopted. But I think that Draghi may have realized that he doesn't want to have a situation where he has the euro in complete free fall. But they do want to, I believe, try and get it as close to parity with the dollar as possible. This is, of course, good for European exports. It makes them more competitive in foreign markets. it helps their economies tremendously. So that here is alleviating some of the pressure of the strong dollar. That, of course, is not good for the lower for longer thesis with interest rates, because one of the issues that the Fed has cited is their concern about a strong dollar. I don't necessarily know if this is enough to kind of assuage that concern for the Fed, but it is definitely taking a lot of pressure off of Chair Yellen and company to go ahead with that interest rate hike. But we'll have to see how that plays out this week. You're going to see a lot of that being the theme for this video, that we're going to say that a lot of Monday and Tuesday are going to be very important, I think, days to decide the end of the year for a lot of things. Anyhow, dollar coming off a bit. This, by the way, is phenomenal for corporate earnings going forward, U.S. stock corporate earnings. One of the things that they have been discussing is a lot of fear about a strong dollar hurting their foreign earnings when they're repatriated, and this is fantastic for that. Here is the elephant in the room, bonds themselves. So we had a crash peak in 2009 in the Wayback Machine of 123.15, and I've been using that. You can see it was support here. It was sort of resistance here. We've been trading around both sides of it here. It was again a little resistance. This is the big pass don't pass line. And you can see we were in a bit of an uptrend, and now we've broken that and starting to form a sideways to down pattern. My concern has been for this to kind of fall out of bed, and that, of course, would mean rate hikes are coming. And it would, of course, mean trouble for stock market PE multiples. When interest rates are low, and at the low as they've been now, stocks have taken on a better, I guess, a higher than usual PE multiple, meaning those earnings are valued more. As their bond competition comes in from interest rate hikes, that PE multiple needs to contract, and that will be very ugly for momentum stocks eventually. I think what has kept up the cohort, the FANG cohort, so to speak, is the lack of growth. And I'm going to discuss that in a little bit in my Fed keys coming in. Anyhow, with regard to the bonds, the 118s held, there was a bounce, and we have to see how, like I said, how this is going to play out. If this swing low gets taken out here in the 118s and the 117s, I think we will see the 114s, and then that starts to get a little bit dicey, in my opinion, because if we lose that area, then the lower for longer thesis is in much, much jeopardy. I'll address the lower for longer thesis when I get to my 6 Fed keys, and we'll get to there in a moment. Anyhow, we get the 200 MA here. We got up here. This was a quite bullish pattern. We had a bit of a pullback and then closed very strong this day and then completely fell out of bed here. Look at all of this engulfing, how many days it engulfed, and this was just still a bounce inside. The bounce was quite powerful. It's good, but this pattern is this is a bullish pattern that failed. It's in a little bit of jeopardy until that high can be taken out. So I am cautious with bonds as long as we are still below the 123s. Another huge elephant in the room has been the deflationary story of oil, copper, and any other commodity you can name. While oil in the CL terms, which is the futures contract, isn't making new lows, the USO is making new lows, albeit slightly, albeit close to the channel low. This probably will be due for a bounce at some point, but my issue here is that as oil comes in, that is showing to me more deflation in the system, more slowing of growth, and more risks to the overall market. You can see, though, we are basically at the range low, so this is kind of do or die for oil. I'm going to show you just quickly the CL here. We're not quite at the low there. We are hovering around a 78.6 Fibonacci retracement. Just for shiz and giggles, let me show you what this looks like on a longer term pattern. This was the crash in 2008 and 9. That took oil down to 33.20. This to me has been sort of the risk that I think we can see. We did rally from $10 all the way quite high to 147. Crashed, had a response rally, and now we have been in crash mode again. You can see we are below we looked below primary trend, rallied, we're below it again. Tried to check back to it, and now failing again. The risk, of course, here is one of these scenarios. I know Goldman Sachs has been looking for a move back down to the $20 area. I haven't really been on board for that. I've been thinking that oil is probably trying to find some type of a bottom here. It doesn't mean I don't think that this low can be taken and we can come back still lower into the 30s. Maybe they want to try to even print 29. I don't know, but I've been thinking 33 to 37 area. These lows and this breakout would be the support. It has been so far. Maybe we come back and have a double bottom. I don't know how that's going to work. But this is increasingly scary because if this does really crack, you're going to see a big move down in the oil complex, and that could fuel a big break in the S&P 500. Again, I've been using this as the barometer for global growth. The stock that, of course, is the big elephant, or the 800-pound gorilla, or the big boy, is Exxon. They have the best balance sheet. They are the number one. They're number one, of course. They rallied up quite high. I had been looking for 83s and 86s. We even looked above, but that has not been sustainable. That to me means global growth is in jeopardy. As long as we're below 83 and 86. And I don't want to get into how I got into those numbers too much because it could take the whole video, believe it or not, but that is very important. But what is important here is that we are now making lower highs and lower lows, and the pattern is a little bit in jeopardy. We held the 50% fib. I've been looking for a retest of this somewhere between the 50 and the 61.8, and the breakout being 75. It's 98. I have some put ratios on here that are now starting to work. If this gets too extreme, it could be a problem, but we are getting into where the sweet spot of that will work. I would be looking for some type of a right or right out long here. I really do hope it presses still lower and that the 50 wasn't it, but we will see how that goes. So I am looking to sell some puts and maybe even buy some shares as we press into this area for right or right out play. All right, that was... The global growth picture doesn't end in the United States. Increasingly, we know that China is more important. I wouldn't say more important, but their economy is getting more important. Not more important than the U.S., but getting more important in relation to where it has been in the past. 40.64 was an important breakdown. We retested close to there and now have just had some responsive selling. We are at the low end of the channel here. This sort of bounce channel really needs to hold, or we could see lower, but lower might not be terribly lower. I did say that there's a primary trend and a 71.8% Fibonacci level a little bit lower. So if we do test below, we really might just be testing into there. You can see there's sort of price memory. There's a big volume profile distribution. Let me try and get a little bit closer here. Yeah, it's on auto. It should be... Yeah, there we go. You can see down here there's a big volume node. So if we do come lower, it might not be terribly lower, but China, I've said, doesn't really need to so much rally as it doesn't need to crash. If we start getting in this type of mode again, the stock market here will follow suit. So let's see how this goes. It's not so healthy that this was retested so quickly. This was the buy. Rallied, and now we're basically back here kissing our cousins again. So if we lose this 36.80, I would say the play is short down to here. I would like a put spread or a put ratio, being that we have been coming down for a while. There will be, I believe, some responsive buys down here. And if we can take this, if we can break the downtrend, that would be a good place to play the addition game, like if you want to play for a move back up. So that is FXI. We all know there are stocks here that people like to play. There's BABA. Back here, this was the peak of Singles Day. Here we even peaked a little bit ahead of Singles Day. This is not such a bearish pattern. It's not really that bullish of a pattern, but it is basically hovering into this distribution. If you can take this high here, I believe that the 100 will be in play. So let's keep... Ideally, the best thing that would happen here is this basically builds this out even further, works off some of the excess, and then goes. So it builds a bit of a shelf here. That would be the ideal scenario. I'm a little cautious on this. This stock has not acted that well technically. It's had a lot of false dawns, so to speak. So I am still a little bit cautious with BABA, but cautiously bullish at the moment. BIDU was one I was very bullish on. I had talked about it being coming up to the channel high. I guess this one just went even further. This was a very bullish candle. We've taken back a lot of it. You really don't want to see the body of this candle violated. You can see we are dangerously close to there, where these, you see where this is right in here. This is around 206s. So if you're bullish, just use this low here, I would say. If you're kind of late to the party as your stop, anything below this low of 202.55 to me is probably going to be a short for some type of a pullback, maybe to trend and to retest the backside of the old up channel, the old down channel line. I would be look to play this with put ratios or put spreads or some type of a move for lower. It's just moved a lot quickly. I think there's just some responsive sellers back up into this volume distribution. You can see this was another big node, and I think that it just met some sellers. Pullbacks aren't, to be feared. I would say that this stock may have turned the corner and is a little bit more bullish, but I prefer buying the dips as opposed to chasing the rips. This IBB is also a huge proxy for growth. You can see it had the head and shoulders top, the breakdown, the check back, the double bottom, and is now it broke the downtrend, but is doing it more so by time than by price. The issue here is we have been making higher lows, but we're not making higher highs yet. I would say once we had a little bit of a look above here, fail, and you can see how that resulted. We held the 50, which is really good. This was a lot of support here, then it became a lot of resistance. Now it is supporting again, a look below with support, and then rallied back up. As long as the 50 MA holds, I can countenance the long in IBB. You can see it even filled the gap. It's done a lot of things right technically here. My big fear with this, though, is that we've reached peaked earnings in the biotechs. All industries look the cheapest look the best when their PE multiples are the lowest. If a lot of regulation comes in, those PE multiples are going to look quite more expensive because drug companies will not be able to get as much money for the drugs as they are getting now. This would be their peak. Hillary Clinton has talked tough. Bernie Sanders has talked tough. I don't really know as much on the Republican side, but I think Trump is a little bit open to maybe doing something with that. We'll have to see. Like I said, 50 MA was key. This bar is going to be the anything above there. I would say if you can take out the high here of 334.82, probably retest these highs. The more they get banged into, the weaker the resistance becomes. You can see though it's the kind of the beginning of the next volume distribution, the next in the profile. It's also really where a lot of this big breakdown took place, so it doesn't surprise me. There is a way to look at this though that I think is very encouraging, and that would be like this. We all know what an inverse head and shoulders pattern. This is a little too low for this. Let's use this. This is the it could be an inverse head and shoulders pattern here setting up. This did come back a little bit too much. You really ideally would have liked to have seen it stop here, but we're back above it pretty quickly. So if you can take these highs, these 341s, basically 341s, 343s, then I will say that we probably will rally back up into the 356s to maybe the 360s and retest that sort of neckline breakdown again. So that's how I'm playing it. My favorite is the Gilead. This has not been really, there's really been nothing to do here, and I haven't been talking about it as much because there really is not. Was in a bit of a triangular wedge. It has gotten below there. It is now roughly up above the downtrend, but my fear here is, of course, lower highs and lower lows again. You really want to see the downtrend, in my view, snap and then play it long. I don't mind playing this with put ratios if you want to get long lower. Ideally, maybe we would have a retest about in the 85s again. I think that would be a good responsive area. Okay, so that covers the 6 market keys. Now we're going to discuss quickly about the 6 Fed keys. You just want to write these down. This is what I look at. When anyone ever asks me my view on the Fed, this is really what I'm looking at, so you can kind of do this the same. Of course, the big jobs numbers, the non-farm payrolls. The ones this week came in, I guess, fairly solidly. They were a little bit better than consensus. I'm still concerned that the participation rate, meaning the percentage of Americans working, is the lowest it's been since 1978. That's saying quite a bit. Their wage growth is not really, it did uptick. It's been upticking a little bit, but there really is no wage growth. It's really quite pathetic. And a lot of the jobs are seasonal. One of the things that were highlighted, that construction jobs were pretty good. Yeah, I mean, it's still 50 degrees out. Construction jobs don't really stop until the winter, so I think a lot of that has been pushed a little bit longer, as well as seasonal hires, for the holiday sales. And we all know those have not been doing well, so I don't really expect a lot of those jobs to carry forward. I know the Fed is looking at this. This is important. Janet Yellen is acutely aware of these factors, so I'm not so worried about that. What I am worried about, though, is the GDP number. The Atlanta Fed has lowered the estimates now on this twice. They had lowered it, raised it, and now lowered it even lower. It's like 1.4% they're expecting for the fourth quarter. That is really weak, again below the 2%. GDP is basically stall speed. The Fed has mandated 2% as their inflation target. They don't even, I guess, expect to see that until 2018. The way to get there quicker, of course, would be to do more QE and not to hike rates. We'll have to see how that plays out. Keep an eye on that Atlanta Fed GDP number on their estimates. It's very important. Durable goods orders, one that I have been talking about for a while. It's very weak when you X out airplanes and autos. Autos could be reaching peak levels. One of the things that have been highlighted by the hawks, it kind of is a circular reference. They keep talking about mortgages and loans and construction being strong and auto sales being strong. Yeah, that's true, but they're also contingent upon low interest rates. If interest rates start rising, those auto numbers and those housing numbers that have been so supportive are going to become drags on the economy. Will be a lot of trouble. ISM, that's another reading I find really important. There's two, the manufacturing and the service. They were both contractionary under 50, meaning deflation, recession, weakness, not good. PMI, also another one, very important. Again, contractionary below 50. And of course the dollar. The Fed is acutely aware of the dollar. That has been a big concern. Yellen mentioned it. They did get a little bit relief, as I mentioned, with Draghi's comments, but it is still a bit of an issue. And then the seventh one, the unofficial one, is of course the S&P 500. I kind of asterisk that one because you'll never hear the Fed mention that. They don't like to be told or like anyone to believe that they watch financial markets, stock markets. But Yellen did in her last testimony mention the wealth effect. She didn't call it that by name, but she did talk about the stock market prices, so we know they watch it, sometimes maybe even tick by tick. Very, very important. Keep that in mind. If the market is up high into the next Fed announcement, that could be trouble. If it's below, that could be a good thing. So let's jump into the kind of the bulk of the conversation here. Let's get into the stocks. I've told you for a while I've been fearful that this is a big rounded top forming. You can see we had a bookend here, a bookend here. That is confirming of that type of a scenario, a little bit nerve-wracking. The good news is this rally did come up higher than these kind of highs here, which would have, as you can see, it was stalling out here. There was a lot of concern for me here. It rolled over. We did make a higher low here, which I did call. And then once we took that out, that was good. The danger the bulls face here is that this rally has come up high enough that this would constitute a lower high, and it would be a lower high from high enough that it could really, really cause problems in the market. The good news, I guess, is that we came back down. Look where we held the tail line of the upper distribution support. This was the old high here of the 201.90. It didn't even quite get that low. And then rallied up quite high again, consolidated here. This is really where the problems start a little bit. Consolidated here. Look at the levels, the 208.97. That's another old reference high. Consolidated on that. Looked like it was going to move higher and then completely fell out of bed with these 2 days down. The good news is that we didn't take out these 204s. I did say anything below 207, put 204, 205 into play. We stopped at 204.75, and then we reversed pretty strongly. We didn't even get down to retest the 50, which is really what I kind of thought we might go a little bit lower. It's healthy that we didn't. I guess it shows the strength of the market. It also shows that people are buying ahead of important levels again, which, as you know, gets a little bit iffy. I keep giving the analogy of the slingshot. A half-cocked slingshot isn't going to fire. It will fire forward, but it will not fire as forward as a fully cocked slingshot. Anyhow, this now is a key pivot. If we break there, we are in deep trouble. What would deep trouble look like to me? Deep trouble could look like a move to the 199s to retest this breakout of the bear flag, and maybe even 197s again, and potentially 196s, and maybe 195s. These are all important levels, both horizontally and Fibonacci-wise. As of now, though, we did have a pretty big reversal on Friday, and we closed back above that key 208.97. And took out all of Thursday's decline. We didn't quite take out Wednesday's, but we closed quite strongly back up into this range. So the question is going to be here, was this look above and fail the real move, the truth? Or was this look below and fail the truth? We basically are back to where we started. So my answer to that is this, is that I'm going to give you the two. The answer is both of them right now are valid arguments. And I believe that we will get the answer early on in the week on Monday and Tuesday. If Monday and Tuesday are weak and we are down again here below these lows, below this 207, I've been saying 207 is the key for bulls to hold, and then 210 plus is the key for bulls to take to get to the all-time highs. If we start losing the 207s again, I'm going to be real cautious, and I'm going to think that Friday was not the truth. You can see that this is the old up channel from the 2011 lows. We lost it here. We kind of reclaimed it here. Lost it again. Kind of trying to reclaim it, losing it, and trying to reclaim it. It seems like the market is getting a little bit tired. That is worrisome. The good news is that it is seasonally. This is very strong time for the market. We do caveat that with the potential Fed interest rates that might not go over so well in bull land. But seasonally, we get Santa Claus rallies. Maybe we do just chop forward, sideways, or go higher. I've discussed that the Fed raising rates is a risk, and also the possibility of the narrowing breadth in the market eventually kind of tumbling over the house of cards. We'll have to see how that goes. I will say that Friday's range now is the key, really the key. Anything above this 209.97, let's just keep it at 210. I keep saying 210. I'm going to stick to that. 210 plus bullish. Anything below there, iffy. In this range is iffy. Anything below these lows is a short. I believe will get real ugly, actually. with the caveat that the 50 at that point could kind of support it. But I'm going to just stay with the range. 207 to 210 is sort of the buffer range. There's nothing to do there. Below 207 is iffy, to 205s, 204s, and if those lose, then 202s. And below, anything above 210 puts 211s and all-time highs into play. So below 207, bearish. Above 210, bullish. In between, just neutral. Just keep it simple, stupid with those levels. I promise you they will save you a lot of mental anguish and a lot of financial potential anguish. IWM, not really showing us much. Really been the laggard. It's not above the bear flag. It is still kind of below there. The good news, the one redeeming quality is that we are above the 117.37. I might get a tattoo for 117.37. I've talked about it for ad infinitum for so long. It really is important, though. It's good we're above it. It would be better if we were above 120.58. Then I would feel more comfortable. The bulls here, higher lows, slightly higher highs. Again, could be a inverse head and shoulders pattern. If we take these highs, I think these highs will not resist all that much, and we could see channel highs. Keep an eye on that. The 117.37 is sort of my pass, don't pass line. You could just use this channel too if you want, or the 50 MA if you want to be even, I'll give it a little bit more slack. But this band to me is really important, and if we're below there, I get iffy. I'm just gonna keep it. That's been my tune for the better part of 2 years. Let's just keep it that simple. Qs, what can I say? Rockstar status. The narrow band of stocks that I have discussed that have been ruling the roost, the FANG stocks, the Facebooks, the Amazons, the Apples, the Netflixes, the Googles, they have been holding up relatively and absolutely strong. We got up to these highs, a little bit of maybe some responsive selling, and we're just kind of hovering up here, really still pretty good. If you're long and you want to use a stop, this gap range, it's really narrow, unfortunately. So let's just use Friday's range since it was big and it's bold. Anything below 112.62, I'm a little iffy. Anything above the highs of 115.33, I am more constructively bullish. There's a couple of ways to look at this. This could be, of course, the platform here is frozen, which never makes it easy. I cheat a little here with the Fibonacci retracement tool. But if you want to take a look, this could be, and I'm using the pullback low. I'm not using the absolute low because this would be a lot. The 1.618 Fibonacci extension, I guess these numbers maybe weren't as precise where I drew it, but up here 124.60, 124.51 to let's just say 124s are the 1.618 Fibonacci extension, and that's where I think we will go if this breaks. This could be the blow off top we've sort of all been waiting for. Anyway, let's take a look at some of the stocks that make up that. Just one more thing with SPY. The TDA is doing some kind of a software update, and the market maker move isn't showing. So I just did an average of the at the money strangle and the just out of the money. The at the money straddle and just out of the money strangle, and I came up with like $2.18 or so for the expected move for next week. I could almost assure you if the move is down, it will be more than that because the VIX will increase and you'll probably be looking at a minimum of $3 or more. We moved $4 this day, so I would expect a bigger move. So just keep that in mind. If it's up, it might be a little bit smaller, although I even still think that could be a little bit more violent because you still have a lot of people, I think, who might be thinking short and they'll get squeezed. This, of course, was a big squeeze here on Friday. We'll have to see if that dissipates or continues. But a move lower, I do think, could be a little bit more violent than the SPY options are implying. And that's, of course, why I always say that when volatility is low, you want to play directionally. So One other thing with Apple, this has been also showing that bit of a rounded top potential, what's making me a little nervous. And I've been saying anything below 119.75, just let's call it 120, is a little iffy. However, we did get a move that I was anticipating, and I talked about potentially getting the channel low in at least 115, which we got. However, Friday, look at this. It's not exactly a Maribozo because there's tiny little wicks, but it's a pretty big engulfing pattern. You have 3 days down and 1 day up that engulfed it all. That is really, really pretty bullish. I would say at this point you can use about halfway on that candle as a stop if you're long. These lows here, look at where we were here, 117.12. So let's just say 117.12, 117. You could even, if you want to keep it really simple, 117. Anything above 117, I would say you can be long here. Anything below there to me is a iffy, if not short. If we get above the 119, yeah, see, this is the only problem. You have a downtrend line here, a 200-day moving average, which has been a bit of a problem. So you might get a move up into the 121s, which is a looky here, a bit of a gap fill, and that could resist, although I don't necessarily know that it will. It might do one of these and then go, but this is a little bit encouraging. So I would say that, like I said, I don't want to keep repeating myself again, but anything above 117, I'm on board with being a little long on Apple. Anything above 120, I'm even more on board, and I would be looking to take some profits here. If we do bust through, I do think that these highs will be in play, and I do think that we could move significantly higher. If we lose this bar completely, just forget it. It's all out short. That's just how it is. Amazon, consolidating, forming a shelf up at the 1.618 Fibonacci extension. I bet you never saw that coming. That is pretty bullish. You had your shot, the 20 MA supported. It's rallied up. It's formed a bit of a shelf here. I will say this, though. Look at these lows. These are what you would call basically equal lows, tweezers, 161.48, 161.40. I'm sorry, I'm saying one. Wow, that's kind of dating myself a little bit, right? I remember when Amazon was still in the ones. And I was trading it back then. Pretty cray. Anyway, 661.48, 661.40. These two double lows are very key. If you're long, you want those to hold. If you're long, and you can use those as a stop. If you're looking for a short entry, you can see a hammer here, a little hammer here. These are all hammers. If you lose this range again, I do think we will see the channel median a little bit at probably at the very least. I would be looking to short these lows just for a day trade maybe. I don't know if I would want to be maybe for a swing because it's a pretty good trade location. But if you lose those short, if you take out the shelf high, then of course we're looking for long and maybe even back up to the artificial channel high that I've drawn in. So which way that will round and round she goes, which way she breaks, nobody knows. But those are the levels, and we just play by levels. Takes out the mental kung fu a little bit. I'm gonna jumble it up a little bit. We're gonna go to Ambarella for a minute, just because I have this written out alphabetically. So if you look where this rally took place from, this 48.50, we've retraced that entire move. The real big breakout was 36.48, and I've been saying that it's really possible that we do see that level along with a trend touch. So you had earnings that came out the other day. They were good. I will concede they were good, but I will also concede that their guidance was crap. You've had a bit of a look above the channel. You can see I drew in the channel. It's failed. We're back below. You've had a little bit of responsive buying. I do say it's concerning that you were below the earnings day body low. The close was 57.88. So I'm going to keep it really simple. If you can get it back above 61.75, I will say that we should be long Ambarella. If we are still below this body low and this low here, this 57.88 to 56.33, then I would say you want to be flat or short or just cautious. Earnings bodies are very important. They're sort of, if you've ever heard me talk, I talk about Fed day ranges. Earnings day ranges are really key. You're going to see that even more personified in a minute when I talk about FireEye. I'm going to jump to GoPro just because these two are linked. Look at this piece of junk. I mean, I've hated this stock forever. It's below the IPO range, comfortably below the IPO range. It was trying to consolidate, and it did, and it broke lower, and it consolidated again, and it broke lower again. You know, a lot of people gave me a hard time with this stock, and I tried to warn you. I've been thinking this thing is going to be a single-digit stock at some point. It looks like it's really well on the way there. Will I be shorting here? I mean, maybe. As long as you're below this 1886, you can be short. If you start getting above there, it starts to neutralize a bit. I mean, this thing is really oversold. It's probably due for some type of a bounce. You can see the steepness of the decline is sort of mitigating. It could be forming one of these rounds. I would really love for this thing to rally back up to the downtrend line to reinitiate a short in this thing. I had tried this thing long for a little bit. I got out of it just for, I've played this thing both long and short. I've played it really successfully short, but my calls in that have been I think pretty okay. Just be a little careful, pressing lows. I like to short these things on rallies, not pressing lows, but you can see there's not a lot of interest in this stock. It's rather weak. I would be a buyer if it does get to the channel low. Currently, I don't know that it's going to happen early next week, but the 8s, maybe the 7s. We'll see. I really thought that this was a buy. I tried it, the 1.618 fib extension lower. It just kind of chopped and then took me out. I got out, and now I'm just sort of watching. So we'll see. Chipotle, holy cow! This was in a big up channel. It snapped here. I warned you. It got to the range low. It got the gap fill. It got the 61.8. And then it rallied back up. I'm sorry, first it got here, rallied, failed at the backside of the channel. Now it went lower, a lower low, which always concerns me. It was off. It really would have been better for Chipotle if this one would have came down here, but it didn't. This one did, rallied up, still lower low, collapse. I had said below here was a short. Boy, was it. And it rallied back up. Look where it came to, roughly some price memory at the downtrend, also where the old gap fill had been. Now came lower. It was trying for a double bottom. The big problem is Friday they came out and lowered their guidance. The stock was trading in the 520s after hours. After a pretty good rally, it is now below these lows. I am very, very cautious. 100% retracement here would be 472. And I want to show you on a longer time horizon. I don't know that this happens, but it very well may. There was an old high here and a big 61.8 down here in the 434, 442 area. That was really this gap fill and really where the breakout really took place. I'd be a buyer down here, frankly. I'd be looking to sell some puts. Maybe it does get down to the 376. I mean, I don't know. That to me is a lot too fast. I wouldn't really be playing for that, but I would be playing for put ratios or put spreads for a move down here. If you want to just kind of sideline it, you're not comfortable with playing the spreads and the ratios, just wait here. You can try right or right out with stock, or if you are comfortable with selling naked puts, wait till it gets down here and then sell some out of the money puts. By that time, the premium should be pretty jacked. As Larry David would say, pretty good. So that's what I'm looking for with Chipotle, but I do think lower before higher, maybe much lower. Facebook, my favorite stock in the entire world, the universe, the galaxy. I've been talking about this stock. I was bearish from 38 IPO. I turned to 20. It got to 19, but I never looked back. It's been very trying at times. It is basically doing what Facebook does. Look, it got up to highs, consolidated, and did have a pretty big pullback to the price. I've drawn an up regression line here. I mean, you get analysis from me on Facebook that I think, I don't want to be too braggadocious, but really second to none. And it has worked phenomenally, so let's just keep doing what works until it doesn't. I really want to narrow in on this area, though. So let me bring you into kind of modern times. We're out of the medieval days. We would rally on earnings and then consolidate, have another kind of false dawn rally, break down lower, get everyone freaked out, and then consolidate and rally. Look what happened here. Rallied on the Google earnings, consolidated, had the breakdown. I don't know if this breakdown would have been as severe if we didn't have that flash crash. Look what level it held, though. These levels, they work. It rallied up. The pullback low was really probably where this pullback should have stopped, around 83, and rallied up, got back up into range, pulled back, retested here the breakout of 86s, and then took off. A lot of this was done on Google's earnings. We have this, look at this pattern here. This pattern is almost identical. My fear, of course, here, though, is that there is a bit more of a pullback. So Facebook, to me, is longer term, I'm still bullish. I think this stock can go much, much higher. Short term, I'm a little concerned. We did get the 1.618 Fibonacci extension of the 109.28. It even got into the 110s. The big play for me on this stock is really not on anymore. I believe that this will consolidate sideways. It may want to have a little bit more of a break higher at some point, but my fear here is a little bit lower. The stochastics are rolling over a bit. I would love to do a right or right out long somewhere between the 50 MA and the 99 level. I was really hoping this was going to get it. Again, the slingshot was half cocked. That's why we got the rally, and it's been stalled out a bit. I believe, like I said, longer term, bullish Facebook. Short term, just a little bit cautious. Just keep an eye on this box. If you can break the box to the upside, it's going higher. If we really start losing it to the downside, we're going lower. And the fear I have is that we have a lot of tests on the low of this box. You can see we had a lot of tests on the low of this box, and when it snapped pretty violently. So I think a snap of the box, you can play short term, maybe put spreads or put ratios for a move into one of these reference support numbers or fib levels. And if we break here, I do think that the stock will go higher. FEYE. I don't know. I guess this could be constituted as a silliness stock. I had been really bearish on this stock for a long time. I flipped to bullish. I got out again. Again, it got bearish. And I had tried to put ratio. It kind of got through it a little bit. I made some money on the short end of it. I tried getting long here. And I've been patient. 1 touch, 2 touch, 3 touch, and now we're breaking. Remember I said about earnings day ranges? We are now below this low 21.75. So I bailed on it on Friday. Actually, I should have bailed a little bit sooner, but I wouldn't say that I got the worst price of the day, but I definitely didn't get the best. I like to often do things on closes, but it became really evident to me once we lost this 21.38 that it was going to be a bit of a problem, and I kind of got bailed. Look at the high of the day here. It was 21.80. You broke. You tried to retest, and then you took out the low again. This, to me, looks like there's something wrong with this stock. I just want to show you Palo Alto. That is the kind of the leader in this space. This had a head and shoulders and a false breakdown. It's now above the shoulder. This is a very bullish pattern. When a head and shoulders breakdown fails, it probably can even see the highs or even higher. Just be a little careful with the earnings gap day. We're above that high. So as long as you're above the 185.10, I think the stock is still long. Start getting into that range, it's a little bit more iffy. Be a little bit careful. This is a high momentum stock, high multiple stock in a sector that is sort of a little bit on the wane. But the point is that this is stronger. CYBR, look at this. It's weak. It's down near these lows, but it's not making fresh lows. Not all-time lows. So that tells me that there's something wrong with FEYE. I don't know what it is. I don't really care what it is, but the price is telling me that there's something wrong. Would I initiate a short here? I might. My fear is that you have 1, 2, 3, 4, 5 days down now. I don't like that. To first initiate short, I don't really want to be long, so I'm flat here. What could happen is one of these where it's a bit of a look below and fail. So I will try long again if we can get back up above. Like, let's say Monday we had a gap, or if we opened low and then rallied up, that to me would be the strongest. If we opened at the low and then rallied up and took out this high, I would probably re-enter long and use that again as a stop, the 21.75 to 21.80. So let's see what happens there. But like I said, this stock is not acting right. I'm very, very cautious with FEYE here. Google, strong like bull, right? My concern with this is this follows. I drew in an artificial channel high. I drew in this artificial channel high. I've drawn in a wedge. it's getting a little bit, you're not really buying low here. You'd be buying a little bit high. Buying down here when it was riding the channel low was probably a better place than to, first initiate up here. I will show you this, though. There could be a bit of a move up here. It is just getting a little bit steep, but, it's still bullish. Anything above the 752 is still bullish in my view. Since you have a hammer low here, you could even use 758 if you start getting it below that. I'd even give you the proposition that you can use the 20-day moving average because it was a support here and it's been supporting here. So if you lose these 2-day lows here below this 762, I would say you can probably play it short for a move, maybe even back down to the 50. If you can take out these highs, you'll probably see the 800s print. And who knows, maybe even still higher. So Google, I'm cautiously optimistic on, but I just feel it's a little late. I just feel like it would be a little bit of a chase. If you're long, sure, stay long and use these 2-day lows as a stop. And if you're looking to short, use the snap of the 2-day low in the 20 MA as an entry point. I will be doing that. But if you break up here, you could see a little bit higher, maybe dramatically higher. Netflix, wow, pretty bullish. Stock is done a lot right. Look at this. This was the head and shoulders. Let me get rid of this. It's distracting. You had the head and shoulders here. It broke down. You had a bit of a check back. This got a little bit more into the shoulder than it should. However, it failed. We were consolidating in range. And now you've taken out the head and shoulders, the right shoulder high, and that is bullish. I will caution one thing. This could be potentially a double top. I don't know that it will be yet, but look at these. You had these inverse hammers, spent a little bit of time consolidating, and then fell out of bed. Look at this, inverse hammers here, consolidating. My fear is a fall out of bed. So I would be a little bit cautious with Netflix. If you're long, just stay long. You could use Friday's low as a stop. That's the 25.75. If you want to initiate short, I would use that also, believe it or not, because look where the body here is. Look where these lows are. You'd be below those 3-day lows. I would use that as the short and probably can play to 115 to retest the breakout, maybe even 110, maybe even do some put ratios with these being the lower strikes and something up here being the higher strike. If this does break the 3-day high, then we are probably going to go much higher, maybe do a Fibonacci extension, which I don't have drawn in. We're running a little late on time, so I'll let you handle that on your own. I believe I had drawn it in before. I think it was like 151. I'll use 150, 151. I think we've gone long enough. I think we could wrap there, actually. So if you're not following me, follow me on Twitter. My handle is @JustinPulitzer. You can follow me. Also, if you want to get these videos, you should hit the subscribe button below. You'll get notifications for weekend reviews, Periscope rebroadcasts, and special edition videos. Be sure to hit the thumbs up. Let me know if you like the video. Comments always help. They help me make the videos even better for you guys. So let's have a good rest of our weekend. Happy Hanukkah. Tonight's the first night of Hanukkah for my Jewish followers. And cheers. We'll see you next week, Monday.